Welcome to Inside the Deal. I'm Suzanne Stevens. Joining me today is Bob Profusek. Bob is Global Head of M&A for the law firm Jones Day. And Bob, we're here to talk about the idea of private equity coming in and helping to recapitalize the financial services industry. Certainly very topical right now. I'm curious, how big of an appetite is there for private equity by private equity firms to get into the financial services industry, given the losses that we've seen with WAMU and National City, two deals that involved private equity investments?
Well, one of the things that makes this particular circumstance different is that we have a debt crisis and we have a financial institutions crisis, but we don't have a investment capital crisis. There are oceans of equity capital and other kinds of mezzanine, that sort of thing, capitalization available. Private equity is awash in money. And so finding opportunities and putting it to work is certainly what they're in the business of doing. It's just a question of picking the right timing. There have been paper losses, I suppose, at WAMU from TPG's investment. That doesn't mean it was a bad investment long term. And you're going to see a lot more private equity involvement in financial institutions, whether banks, investment banks, all sorts of associated services like the monoline insurance industry, which is critical, the CDO market, and all the rest. So there will be a substantial amount of this going forward, no question about it.
Well, federal regulations, though, certainly limit the involvement of private equity firms. Do you think that we'll see a loosening of regulations, considering the crises that we're in?
Well, there's a lot of talk about it. There's been even Treasury Secretary Paulson has spoken about the need to open up things to allow private equity to enter the banking industry more easily. There's something called the Bank Holding Company Act, which makes it very difficult to have 100% ownership. Now that means you can keep your ownership at lower levels. 25% and 10% are magic triggers. So-called club deals where private equity teams up with other equity firms or with strategic buyers. You're going to see lots of those. And there's a lot of private equity interest outside the U.S. where they don't have these kinds of regulatory issues. Lone Star's acquisition of a giant German bank just 2 weeks ago, perfect example of that. Lone Star, obviously, with the name, is a U.S. PE firm.
Right. Well, whenever it comes to private equity getting involved in deals that involve public shareholders, there could be some pushback there and some outcry from the public because of a perceived risk there with private equity getting involved. But you say there's not a huge risk when it comes to private equity money.
No, because private equity has grown up. I think the notion that it's hot money or temporary money and all the rest of that, that's completely off the table. And I think the question is, in my mind, if you step way back from this, are you better off having private equity come in, shore up balance sheets, or have the government have to step in and put the taxpayer at risk? Well, I think common sense would indicate let's let risk capital take the risk and not have taxpayers taking the risk.
Well, it's a question that will continue to be debated, I'm sure. Bob Profusek, thanks so much for stopping in to talk to us.
You're very welcome.
I'm Suzanne Stevens. This has been Inside the Deal. See you next time.